Welcome to our 12th lesson in the Market Profile Beyond the Basics course. As usual, we'll need to review the disclaimer. Trading and investing involve high levels of risk. Future results can be dramatically different from the opinions expressed in this course. Past performance does not guarantee future performance. The presenter may or may not hold positions in the financial instruments discussed. All right, in lesson 12, which is going to be the last lesson in our course, I have chosen to focus on something that is really at the core of Market Profile and is a very powerful tool when it comes to trading. And hopefully you will find it of great benefit once you begin to integrate it in your trading. What we are going to look at are what I call the three essential elements of planning a profile trade. The profile gives us a lot of different parameters and different elements, but there are really three key essential elements from the profile that if you hone in on them and you learn to use them properly, they can significantly enhance your performance as a trader. Now, what are those three magic elements that we need to integrate and learn about in planning any profile trade? They should not come as a surprise to you at this point. As a matter of fact, all three of them are very powerful elements, yet they are often overlooked. First and foremost is the volume point of control. Everyone should learn to focus on the volume point of control on any profile. That is the point on the profile where we've had the greatest level of trading in terms of volume. That is an incredibly significant point on a profile chart. We know that that is the price level with the greatest traded volume during a session that we have a profile for. Now, naturally, the two other elements in the trio are the value area high and the value area low. These are three key elements. If you learn to use them in planning your trades, you will find that they will be, one, very helpful, two, they will help to keep you on the right side of the market and hopefully increase your performance effectiveness and your ability to take more and more positive trades. And this is why, in some ways, I have saved the best for last. As you will begin to see, the techniques that we are going to look at, as simple as they may be, they are really very powerful when it comes to implementation. Now, we've identified the three key elements as the volume point of control, the value area high, and the value area low. On this chart that you see here, I have nothing more than 30-minute candles for the ES Mini, and I have all three of the elements we've been talking about. Yes, I have the value area high, I have the value area low, as well as the volume point of control. The only difference on this chart is that I have them in a developing format, and you will see that this is very useful and very helpful to look at if we are going to trade in any period or in any session. To take a look at these three pivotal elements as they develop in the marketplace. And you will see here on the chart, all three of them are in fact visible, clearly visible, and I could submit to you that actually I could trade this chart simply with those three elements and nothing else. That's how powerful they are. And I'll show you shortly how that is in fact the case. Well, let's first identify where is our value area high. It is this blue line at the top, And if you notice, it jumps up and down, up and down. You see sort of different steps, but it is certainly the top light blue line. And this is an indicator that is found in Market Delta and Investor RT that will allow you to show both the value area, developing value area low, developing value area high, as well as the developing VPOC. Now, these are all volume based, and I had mentioned in earlier lessons that I typically focus on the volume-based parameters. So the value area high and the value area low that we are looking at here are really volume-based. And just as we have identified the value area high, it behooves us to identify the value area low right here. And of course, the volume point of control is right here. And we are looking at a one-day session. Between this point here and this point here. That's a 24-hour period, and it shows us how prices moved and where the value area low and value area high were at each period as we develop throughout the day. This is very, very helpful, very useful. Now, the reason that this is very helpful and very useful is because it really helps us to function in harmony with the auction process, the market auction process. Now, many traders are not familiar with the auction process and how it works, and that's why I want to take a little bit of time to make sure that you are familiar with the steps that are involved in the auction process and how the market works and why the developing elements on a chart, the developing profile elements on a chart are so important and so helpful. And we will also take a look at some trade setups together using this information that we will examine together. The auction process is really a four-step process, four basic steps. The first step, the market does a directional move. The second step, after this directional move, the market arrives at a stopping price. So the market continues to move in a direction, and let's say the market is moving higher. Basically, what the market is looking for as it continues to move higher is sellers. Now, what happens when the market begins to find sellers? Well, it determines that it has arrived at a stopping price. This is an area or a level where sellers are now attracted and are beginning to participate. So the market begins to rotate around this stopping price to see how strong are those sellers. Are those sellers capable of actually turning around the market and changing direction, or are the buyers more powerful, and will they able to absorb all of the supply that the sellers are going to offer or throw at them in this new price range or in this new territory? And that's the purpose behind the rotation around the stopping price. The market is really trying to establish who is the dominant force at this particular new range or this new level that we've arrived at. Now, two things or two outcomes could happen after the rotation. We could get continuation in the direction of the original move, or we could in fact experience a change in direction. When we have a trend, the probability always favors continuation in the direction of the trend. Now, the probability favors, so there's no guarantee, there's never any kind of a guarantee in the market, but certainly there is a greater probability that we're going to continue to move in the direction. And mind you, even if we do have a change of direction, it does not necessarily mean that it is a reversal in trend. It may simply mean a resetting. It may mean a retrace in the market, but not necessarily reversal. Of course, a change in direction could also represent a reversal, but be careful, because you really have to gauge and watch carefully what is going on before you determine that in fact it is a reversal. Let's take a look together at this auction process in action. And I'm going to focus on just this profile here on our chart, this one profile. And let's take a look. It opens here, and then A period shoots up. Then B period shoots back down, and takes out the open of the day, the low of the day, and heads lower. And then C period comes along and shoots up back again all the way up to the high of period A almost. So what's going on here during this first phase of the trading session? The market was looking for a stopping price. This is what the market was doing down here. It was rotating upwards and downwards. There was initially a strong buyer, and then the buyer met sellers in B period, which brought them back below the open and below the low. And then the sellers in period B were met with buyers in period C that brought the prices back up higher. So obviously our stopping price was not in this range down here. There was no stopping price because we navigated up and down through it. It had a lot of volatility. So the market continued to move higher. It evidently found enough buyers down in this area here to push prices further up beyond period E. And then we moved a little bit higher, and this is where we found our stopping price. So let's go on to the next phase. We have a directional move. Okay, we looked for the stopping price here. We couldn't find it. And so what happens is we get a directional move. The directional move takes us up all the way up to here. And once we arrive at that stopping price, we don't just stop there and rest. No, we begin to rotate. Extend the range a little bit higher, come back lower, and this is when you begin to see a cluster form on a profile. That's actually the reason the cluster forms, because of the rotation around that stopping price, and that stopping price is typically your volume point of control. So there is my stopping price. In this case, we have it right on the, not the volume point of control is the one above it. In this case here, and they're usually, both of them are really quite close. I tend to rely more on the volume point of control as the stopping price, more so than the time price point of control. Now, if we continue on with this process, we see that we get our rotation. So here are the 4 steps. We're going through them, and we watch them as the profile develops. The very first one was a directional move to the upside. Then we found our stopping price up here in this area, and then we began to rotate around that stopping price, back and forth, back and forth. Okay. Now, if you notice, the session that followed, same thing, we continued the rotation. We didn't get another directional move. We continued within that same rotating pattern in the auction. That means that in this area, in this range, the buyers and the sellers were still evenly matched. Neither one of them was overpowering the other enough for a directional move. We were still at an area of balance or equilibrium, if you will, between the buyers and sellers, and we continue to rotate in this range. Now, once you understand the steps of the auction, you should be able to identify by looking at the profile where it is in the process. Is it still in a directional move? Or have we arrived at the stopping price? Are we in a rotational move, or are we going to begin a directional move? Now, it's easy to see when you're in a directional move because you will not have too many TPOs racked up. So here just two basically, B and C, A, B, and C3. This is a directional move. Of course, the rotation, you begin to see a buildup as we do here and as we do in the evening session. Now, to some extent, the following session, we had a little bit of a directional move because we began to expand the range, but nevertheless, we really did not expand the range very far, and we continued to rotate, but just rotating in a slightly higher range. So in terms of the extent of how far up or how far down the market may rotate, that range, there is no fixed or set parameters for that. The market will expand up and down and rotate in a range that it defines depending on the orders that are placed and the participants in the market. Now, notice we did get continuation though. So after this phase of rotation, prices did move higher. We did not get a change in direction. The most important thing I want to establish here is just to demonstrate to you those 4 steps, and I'd like you to look at each chart and begin to break up what's going on a profile chart in these 4 steps. The stopping price is always easy to find. Once the market stops, it begins to rotate around that price, and that becomes clear and evident. You will see TPOs begin to build at that price. The directional moves also are obvious. Usually you'll see a strong move up or a strong move down without a great deal of TPO buildup. And of course, based on whether we continue in the same direction or move in the opposite direction, the 4th phase is also easy to identify because you'll see which way prices eventually ended up moving. Now let's take a look here and see how this applies to our chart. Well, obviously this volume point of control, the pink line on the chart, was my stopping price, and you can see each 30-minute period up and down, up and down, up and down, up and down, basically rotating around that stopping price. Now see, when I see the elements developing, actually they are of more use to me than when all is said and done and I'm only looking at one level, because this way I can track and follow what's going on in the market as it happens. I don't have to wait until the end of the day to see where in fact the value area low and the value area high were. I see them develop before my eyes on the chart. So let's continue now, since we've identified our stopping point. All right, now our task is to determine, are we going to continue to rotate, or are we in fact going to move perhaps a little bit higher from this stopping point? Well, if you take a close look, a telltale sign that always lets you know that you found your stopping price and that you're in a rotation, the developing value area high and low, both of them, will converge around the stopping price. So notice how close they are here on the chart. The value area low is right here, the value area high, and look at where the volume point of control is. So when they converge like that, you know you are in a rotational mode around the stopping price. Now, this was really evident in this area here, but things are starting to change. I am beginning to see an expansion or a widening of the range between the value area low and the value area high. And which one is moving further away from the other? It is the value area high that in fact is moving slightly higher. So already the developing elements begin to give me telltale signs about potential direction of price movement in the market. The bias or the prevailing sentiment is for prices to move higher rather than lower based on the developments that we are seeing on the chart. Now, if we take a look at the rotations, we begin here with the first rotation, a slight upward move, and it actually takes us above the value area high. But we experience rejection, and now we're into the second rotation, and we drop back in to value. But notice what happens. We don't even come all the way down to the stopping price, but jump back right up again into a third rotation, and this third rotation even takes us higher yet. So we've made a high here and a higher high there. And watch my value area high continue to expand and rise. From looking at the developing elements, I should now have a bias to the upside. And not only that, it begins to also tell me that the stopping price is now a clear level of support. How is that? Well, take a look. First, it began here. Every time we went below it, popped right back up, closed above it, closed above it. Now, we began to move higher, but we came back in for another test. We came back towards it, never touched it, headed back up higher. My volume point of control is a level of support at this juncture. Now, the market is not rotating around it. It's not coming below it anymore. So these are the first signs that the market is ready to move higher. Now notice, before it continues the move upwards, take a look at what happens. The market decides to come back for a retest of this support level. And this is another very, very important tip. These shifting volume points of control become incredibly important reference points on the chart, because the market will come back again to revisit them, whether they are a level of resistance or a level of support. They become very important markers on your chart. So you may even wish to draw lines, reference lines on the chart, and extend them out further, so that if prices ever come back to them, you have a recollection of where they were. Now, when we come back for a retest of this support level, what happens? The support holds. So now, if I were to ask you, would you be willing to take a long entry somewhere here when we take out the high of this doji bar? And I hope that your answer is yes, because take a look and notice what happens. We move higher yet. And not only that, at this juncture, the volume point of control has even shifted higher and is now above the prior volume point of control. Now, an important point to make here. Just because a volume point of control shifts up does not always mean that there is momentum to the upside or we're going to continue higher. It merely means that the point or the price level where the greatest volume is being traded has shifted upwards. It could be that at this new level where we've shifted up to is a resistance level, and we're going to drop from here on. So be very careful. Don't rush into judgment. Take a look at the price behavior and monitor what is happening. Yes, we did have a volume point of control shift to the upside. That does not mean that it is always an indicative of an upward move. Quite often that may actually become a level of resistance for us. In this case, that's not the case, and we did continue to move higher. We get a retrace here, and notice we retrace down to the value area high. And once again, I would be willing to take a long again here. Once we take out the high of this doji candle, we're above value, and we've established the support back here. Once again, the volume point of control shifted. We're not rotating around it. There's no ambiguity. And take the long, and it continues to move higher until, of course, we get a new shift and a new day starts with a new volume point of control up here. The volume points of controls and the value area high and the value area low are constantly changing, and that's why it is important to track them as developing elements. The volume, the VPOC shifts A, and this one really should be the letter B rather than C, but anyway, A, C, this one would be the letter C. So A, B, C, 3 volume point of control shifts on the chart. All right, now here's another chart, and on this chart we've added a useful and helpful tool to actually numerically illustrate for us what is going on with the volume levels at each price. The tool is an indicator known as the volume price statistics indicator, and you can pull it up the same way you do the bar statistics indicator, and it's called the footprint price, not the footprint bar statistics, but the volume at price statistics indicator. And again, it's standard on Market Delta or Investor RT. And you will find that you'll have lots of things that you could add onto this indicator in terms of buy volume, sell volume, delta, and whatnot. In this case, I've only selected 3 basic columns: volume for each price, the actual price level, I always like to see it so I'm not having to draw lines back and forth, TPOs, and the TPO histogram. Because I'm trying to identify my stopping prices, there's another characteristic of a stopping price. In addition to the fact that there's a lot of volume that gets traded at that level, it is a point where the price begins to rotate around it, so we will get a high number of TPO activity relative to the other prices around it. And if you look closely here on this slide, you will see that 22, 21, 24, the highest levels of participation, if you will, because of the rotation. These prices were hit 24 times, 22 times, and it shows on our histogram and on the column, the TPO column up here gives me the exact number. Now, in this case, unlike the preceding example where we had a volume point of control shift up, this one is shifting down. Now, I've put some numbers for you to look at. This is the price, 1829, and that is where the volume point of control happens to be at 1829. This is the total volume that is traded at that price level, and this is the number of TPOs. So this price was visited in 22 consecutive periods. Now, that certainly is a stopping price where we're experiencing some rotation. Now, after these 22 times, what happened? The volume drops, and that's why we get a volume point of control shift to the downside. Volume begins to increase at a lower level, or a lower price level. At 1827.50, volume jumps up to 45.062, and yet we're still at 20 TPOs at that level, so we're still getting some rotation there. Now, if you look closely, take a look at the value area high and notice what is happening. It's starting to drop as the volume point of control shifted down, and the same thing with the value area low starting to extend lower. Signs of weakness or signs of imminent price drops in the market. Now, here I have an interesting question, because I talked a little earlier when we were looking at the previous slides of the importance of past levels. Notice when price comes back up to revisit this level here, what happens? Price is rejected. notice these wicks, and prices dropped back down. So there was obvious strong selling pressure here. And you can see that there's no moving averages, there's nothing on the chart other than my three developing elements, those three essential profile elements. And the market, you have no idea, respects those levels, comes back to revisit them again and again, and responds to them. Notice now we will get another shift downwards. Sometimes the shifts happen after a big drop. Sometimes they're just subtle shifts up and down as we're rotating and volume is building up. Now here at this level down here, 1850, notice the volume level 47,300 and 12 TPOs. So we have found an area that we've stopped at a little bit. 12 is certainly not as much as 22 or 24, but we're seeing a rotation in the market. So this is another level where the market has paused or stopped for a bit, and we have yet to see the impact of that pause. When we stopped here, those 12 rotations or 12 visits, during them the market went back up for a retest of this level that once existed, and prices were rejected, came back down. Now the next volume point of control up here, 58,117, 13 TPOs at 18.25. Now the volume is increasing up there. Does that mean that we are ready to move higher? It could. It could. We have to watch and observe what actually happens to prices and where they move. So yes, we did get a volume point of control shift upwards. It could mean that we may be moving higher. It could also mean that that's just a new resistance level. In this case, because we see already what happened, it was in fact a level of resistance. There were more sellers and prices continued to drop lower. Now let's take a look here at the shift. It dropped from 1819.25 to 1819, and look at the difference in volume. Very slight difference, but still the VPOC is the greatest level of volume, and so it dropped from 58,117 to 58,865, and now these two levels together really point to a stronger volume point of control, because between them, as we begin to have more and more volume, we want to study what is happening here. And so where do prices go from here? They continue to drop lower. Now, as we push lower with the same chart, again, keep an eye on what's happening on the volume area low. Continues to step down, and the volume area high is starting to stabilize up here, but here's our volume point of control, and prices are dropping lower. Now what's happening down here, and this is where this becomes helpful. Look at the number of TPOs, the number of TPOs, 1, 1, 1, 1. So these price levels were gobbled up very, very quickly and pushed higher. Obviously there are buyers below the value area low in this area here. Now we're starting to see a little bit of a rotation in this area. Have we arrived at a stopping price? Possibly, but if we take a look at our volume levels, the volume levels are still not yet at par with what we had up here in terms of the volume point of control. We need somewhere in the neighborhood of 58,000, and if we take a look at the numbers, we're still in the 40s. So I would expect one of two things is going to happen here. Prices are going to continue to drop lower, or we could have prices start to come back up towards the volume point of control there again. Only time will tell, and we just have to watch the price action, what actually happens. but there is no imminent shift, because simply by looking at the numbers, the biggest number I have here is 41,000, and 41,000 is still much less than the 58 that was back up here. The only time I'll see a shift is if I see something higher than 58 in that same session. Now, what would you expect to happen next here after this rotation? Again, one of two things. We could come back into value and come back for a retest of the prior volume point of control, or we could continue to see a breakdown, prices dropping lower, or perhaps we could begin to rotate in this area for a bit until we develop enough volume here for a level to become another stopping price, and this stopping price then may in fact become our point of support that'll help us propel prices back upwards again. That's what we have to wait and see in terms of the auction. Now, I've added one very simple indicator on the chart so that we could present a simple trade setup. And this setup is so simple yet very powerful. Now, you have to remember, all setups, there are no guarantees in any trading setup. They are just a way to identify a potential opportunity. So in any of the setups that we've presented, make sure you understand two things. One, there are never any guarantees, and two, the market could do anything at any point, and there is no setup that works all the time. So keep those parameters in mind. Given that, let's take a look at what events happen. They could create a setup for us for a long or a short entry. In this case, we are going to look at a short entry, and the first thing that we want to look at or look for is the 5 simple moving average pointing down. So we have 5 simple pointing down. Okay, we have that first element of it. Second, a bar closes below the 5 simple moving average. Well, we had one bar close below the 5 simple moving average, and it was pointing down, and then it went back up and then started pointing down again. Okay, well, this is the first bar that closed below my SMA, my 5 simple moving average. Now, I want to wait for another bar to come and take out the low of this bar, at which point I will begin to think about my short entry, or I should take my short entry. Now, did it happen? The following bar trades below the low of the prior bar. Yes, it does. Okay, so now I could take an entry right away, right at this point, or I could wait and see if I could get a slightly better price. Now you notice, quite often the market will do this. You have another bar and it moves right back up, and it gets you to ponder and wonder, should I go into the trade or not? Again, it is a good probability, but it's not certain. So perhaps you could wait and not enter until, in fact, this next bar also is broken downwards. But if you had entered here, you would still be on safe ground to stay in the trade. This one still did close below the 5 simple moving average, and then when this next bar takes out the low of this bar, I could in fact add to my position maybe another contract. So I would have 2 instead of just 1, because now the likelihood of success in the trade has increased significantly. And if we take a look at it, prices continue to drop lower and lower, all the way down to the value area low, which would naturally be my first target in this trade. This would be my initial target, the value area low. Now, look at prices as they continue to drop lower. The ranges for each of these bars is quite wide, but in fact each of them eventually ends up closing lower, making a lower low and a lower high, reaffirming for us the move downwards. And we continue to have that occur all the way up to this candle here. The initial target, the value area low, is when I would begin to take some of my profits. Or it could be when I would exit the position altogether. However, in order not to limit my gains, I could allow the 5 simple moving average to help me manage the trade. What do we mean by that? Well, we've talked about this before. As we continue to close below the 5 simple moving average and the 5 simple moving average continues to slope downwards, I should be comfortable staying in the trade a little bit longer to capture more profits. Now, where is my stop loss risk management again? Well, I initially, if I would have entered in this bar here, the low of that bar would have been my first stop loss. If I would have entered here after this second candle, this would be my stop loss. In addition to just putting a stop loss initially, you don't want to leave your profits all the way until the end. What you want to do is to begin trailing your stop. And to trail your stop, what you would do is you would keep moving the stop lower to the high of each bar as we drop. The high of each bar. In this case, notice we came all the way back up to here, but we never came to the high of that bar there. This is the high of this bar, and this is when this gets taken out. If you had moved your stop down here, then this is when you would have been taken out. Now, conceivably, you may have been smarter and decided to get out down here somewhere. You will have a little bit more profit, but if you were purely relying on the rules and staying within the rules, you will still have captured a decent move, but you will get out of the market up here. And yes, you could have made more money, but it's always incredibly difficult to capture the full move all the way down to the very end. Now, as an added level of comfort or an added confirmation for our trade setup, it is helpful for us to also add a stochastic on the chart. And notice the stochastic will provide us with an added confirmation for our short setup. Back here, this is when the confirmation came at this point, so it would have probably prevented you from entering a little bit earlier here. We did not have the crossing, but we did here, so you would have entered at a probably a better time, but about the same level where you would have entered had you in fact entered when the low of this other prior bar was broken back here. So the stochastic will help us to refine the entry and is useful to use as part of the setup for that trade. So look for the 5 SMA to be sloping downwards, look for a close under the 5 SMA, and then look for the following bar or one of the following bars to take out the low of that bar, and once it does that, anticipate the market to continue to move lower and put your stop at the high of the bar where you enter. And if you have the stochastic on your side, it'll help you. It'll help confirm for you the setup, and it increases the likelihood and the probability of success. I have changed the periodicity on our chart. Instead of looking at the 30-minute candles, I am now using a short-term periodicity. And this allows us to employ some what I would consider close to scalping strategies. Whenever we drop down to these short time frames, you should not have awfully ambitious goals. Be prepared to take 1 point, 2 points at the most out of the trade. If you want to trade longer term, you definitely will need to be looking at a longer periodicity, minimum 30 minutes. Now, I wanted to demonstrate the 10-minute chart to demonstrate the fact that the three developing elements from the profile are also extremely helpful, even if we decide to trade on a short-term basis, which typically is somewhat difficult to do. But let me show you how it helps us to structure and organize our trades. Anytime you find that the 5 simple moving average comes up to the value area high and then turns around, crosses down, and is now below it, that is a high probability short. Again, your initial target is probably going to be the volume point of control, and you are going to put your stop at the high of the candle that broke the value area high, or I should say the developing value area high. So this is where your stop would be, and you would short at the point when the 5 actually crosses over and is below the value area high. So pick the best price that you can get in these fast, rapid, short-term, very short term trades. You need to be quick, and you need to be in and out fairly quick. And so you need to make sure you're getting in at a price that allows you some room before some room for profit before you reach the volume point of control. In this case, it looks like here we're down here at about 1823 or so. So you have the volume point of control at 19, and you want to be two ticks above it, so 19 and a half. So certainly if you are able to grab a short at 23, 22, 22 and a half, 22.75, all those would be reasonable points to take the short. And that would be your first target. Now, if you decide to stick out the trade, since let's see, did we get any? This is the first close outside the 5, really, so you would have been kicked out if you were using the simple 5 moving average rule, our simple 5 moving average rule. This would have kicked you out of the trade. So this would have been a reasonable first target. However, there's another opportunity that we're going to talk about for another short, and certainly the second target, of course, target 2 would be the value area low. Let me highlight here. The value area low. Oh, oops, this is the volume point of control. Here's the value area low. There we go. And there is, of course, our stop and the value area high. And this is the point of the crossing, at which point we would feel comfortable taking a short, and our stop at the high of the bar that broke the value area high. Now, so several other opportunities within the 10-minute chart to grab some quick trades. Take a look. We already talked about this first one up here. There's another crossing that is also a nice crossing here. When the 5 crosses down or below the volume point of control, and notice we're also taking out the low of the prior candle, this would be a nice entry for a short, with keeping an eye on the target down here, which would be the value area low. Now we come down here, we drop down to the value area low, and the 10-minute bars start to rotate a little bit in this area, and then take a look at what happens. The 5 simple moving average crosses again below the value area low, and we're moving away from the value area low. The simple moving average continues to drop lower, I have a bar here that takes out the low of the prior bar. This would be another reasonable point to take another short for a point or two. Remember that since we are using a short-term periodicity or short-term, very short-term chart, the 10 minutes is considered a very fast, rapid intraday chart. We need to be very, very cautious, and we should not expect more than 1-2 points tops. The sooner you're in and out, the better off you are going to be. Now, the same crossing rule actually also applies for longs. So here on the chart, we only have one crossing above the volume point of control. The stop would be here at the low of the prior bar that closed above the volume point of control, and then we would enter as soon as we get the crossing at the best price that we can, and keeping in mind that our target would be the value area high, and again we just want 1 or 2 points out of the trade, no more than that. Very cautious, very quick. These are akin to scalping trades. I've been asked by some of the students in the class to talk about some scalping techniques, and this is one potential technique using the simplified moving average and the 3 developing profile elements. On this next chart, we switch gears again, and this time we have a 60-minute chart, and we have a weekly developing VPOC and a weekly developing value area high and value area low. So if you take a look here, the value area high that we see is really for the week. The value area low that we see is also for the week, and the VPOC levels are all weekly. The same indicator allows us to do that, to display either weekly or daily. The weekly does not move as quickly as the daily, naturally. It's slower, but it's very helpful to take a look and see how the week is developing. And the 5 simple moving average also gives us a good indication as far as direction. Is it dropping? Is it flat? Is it heading up? Now, the crossings that we just described on the 10-minute don't work well on the 60-minute chart or on the weekly developing elements, and the reason is really quite simple. It's very slow. The 5 simple moving average is quite slow. You might say, well, we still had quite a bit of a move upwards after that. In this case, that was true, but often that may not be the case. The 5 simple moving average on the 60 minutes is a relatively slow moving average. After all, that is 5 hours worth of time before we really get any kind of a change. So we have to use other techniques, and the techniques that we would use are basically involved around looking at the value area low, the value area high, and the VPOC, and determining whether in fact they appear to be levels of support or levels of resistance. If you notice, for instance, here, the week starts off with the value area high up here and the value area low down here, and then we break through it and we get another hour that creates a lower low, takes out the low of the prior session, and then we continue to drop with prices. Our value area high is dropping and our value area low are dropping. In this case, it would seem rational and logical to take a short. And then this would be a trade that I would expect to last a little bit of time, because we're looking at an hourly chart. Now when we get to Monday morning, the first day of the week after the Sunday evening session, we begin to see rotation around the volume point of control for the week. Now recognize or remember that since this is the first day of the week, it's still early in the week, and we haven't had a chance really to have anything develop, and so it's not unusual to get a rotation like that before we see any kind of trend. However, we are coming down in terms of price, and we stalled here for a little bit. Then we have some extreme volatility, as we see here in this bar. It takes out the high and the low, covers a wide range span, but then the market continues to drop even lower below that. The analysis for the weekly developing elements is one that one has to look at everything that's going on and sort of analyze piece by piece. There is no easy setup, so to speak. We look at the direction of the simple five. We look at where we are relative to our value area high and relative to the value area low, and if in fact those key levels for the week are being respected as support or resistance. In this case here, tells us that the value area low proved to be a support level here. We shot up from it, and then the volume point of control was a level of resistance. We dropped, but then we came back much stronger with a very powerful burst to the upside. So it would be reasonable to take a long here at this point when we take out the high of this candle, and sure enough, again, the targets would be the same. The value area high would be my first target, and it looks like we do meet that target, and now there's a level of resistance. Look at the red bar that drops. Then we get another green hour and pushes prices higher, and then we get a rotation. But notice what is happening in the rotation. It's starting to move slightly upwards. And sure enough, now we break out of the value area high. Now, the question is, are we going to see rejection or acceptance of prices? Well, initially we see rejection, and prices do drop. But if you notice, this second hour does not take out the low of this hour. On the other hand, this bar comes along, takes out the high of this hour. So prices continue to move higher and higher. Then they penetrate through the value area low of the prior week and continue even higher to the VPOC from the prior week, and that becomes a level of resistance. Notice prices are rejected, they come down, they come back up for another try, and then they drop. And then we would expect that they would come down here to the value area low as a target, value area high, and then once again down to the VPOC, and then down to the value area low, if that's the case. These three elements work on different time frames, long, short term. The important thing is to understand the dynamics of the market relative to these three elements. Always remember that between the value area high and the value area low, you have 70% of the activity. So when you begin to see clusters like this, recognize that the activity is concentrated on the top side, and keep an eye out for a breakout either to the upside to continuation, or possibly breakdown to come back and retest the levels that we have just left. In this case, we continued to move higher and higher. The developing value area high, value area low for the week are a very useful perspective, even if I'm going to trade intraday, because they show me what's going on in the week and where we are relative to the overall value of where the value is for the week. Are we top heavy? Are we right at the volume point of control? Which of those levels really is providing support? Where is the resistance? So it is a very useful frame of reference for me, even for my intraday trading. Hopefully you have now gained some appreciation for the TPO indicator and how helpful it is to have the three essential profile elements in the development phase and to watch them on the chart. And as you can see, it's useful in almost any time frame. Hopefully, since this is going to be our last lesson, you now have a number of tools under your belt that you can begin to implement. I always recommend caution, proceed with caution, and practice. And don't ever put any money behind any live setup or any live trade until you've tested it on a demo first, until you are very comfortable with it. There are lots of opportunities in the market, and the most important thing is to be proficient with what you do and not to jump in too quickly. We've examined a number of different techniques, a lot of different strategies, different setups. Try them, see which ones make sense for you, which ones are more suited for your trading style, and pick and select the ones that you are comfortable with and that are easy for you to implement. And the only way you can assess and gauge that is through actual practice. So don't hesitate to spend the time to practice these techniques. The market is precarious and things change constantly, so you want to be flexible, versatile, and you want to experiment with anything that you've learned that's new before you put a single penny of hard-earned cash behind it. That's the best way to approach trading. Be very conservative, very cautious, and very careful. And remember, there are never guarantees, any guarantees in the market, and things change constantly. A setup that may work this week may not next month. They are constantly changing things around in the market, and one has to be flexible and versatile. And if you can now begin to mix and match some of the tools that we've covered and examined together, feel free to do so. You can innovate, you can begin to add, you can begin to sort of gather your own observations about the market and integrate them into some of the things that we have discussed. With that, I am going to wish you the very best of success with all of your trading activity, and I thank you for joining me for this course.